We're told that sales will increase at a 10% rate, so I'll put 10% there. We're told our gross profit margin is 46%, so of course that means our cost of goods sold is 1 minus 46, or 54%. We're told that our expenses will be the same percentage of sales as last year. Well, last year they were 20.8% of sales, so they'll be the same in the current year. Let's go ahead and do some of these. Sales, we're going to take the prior year's sales and multiply that by 1 plus the 10% increase. We're told that cost of goods sold is 54% of sales. We'll take our 54%, multiply it by sales. Our gross margin is simply sales minus cost of goods sold. Our expenses, we're told, are 28% of sales. So we're going to take our 28.8 times sales. Notice it wasn't an increase of 20.8%, but 20.8% of sales. Our earnings before interest and taxes then is our sale or gross margin minus our expenses. Our interest expense, we're told the interest rate will be the same as last year. Or we're not told that, but we're told our interest rate from last year was at 12%. So we'll go with that. We're going to take our 12% interest rate and multiply it by whatever number we end up with for debt. Earnings before interest and taxes then will be earnings before interest and taxes minus our interest expense. Rather, that will give us our earnings before taxes. Now, this won't, of course, turn blue until we get our interest expense, which will depend upon our debt. Let's go ahead and pick up our taxes. We were told last year our tax rate was 43%. Going to keep that the same, so we'll take our $69,300, multiply it by the tax rate, and of course, finally, we can solve for net income, which will be earnings before taxes minus our income tax expense. Our dividend payout, we're told our dividend payout ratio is going to be 25%. So we'll put 25% here, and our dividends will be net income times 25%. Our balance sheet assumptions, we're told that cash is 9% of sales. So we're going to put 9% here, and to calculate our cash, we're simply going to take our 9% and multiply it by sales. We're told our accounts receivable turnover is 3.6. So that means we're going to take whatever we have in sales and divide it by that 3.6. So sales divided by 3.6. We're told our inventory period is 250 days. So we need to figure out how much we are purchasing each day. We're going to take our cost of goods sold, $148,500, and divide it by 365. And you see on average we're selling merchandise that costs us $407. If we have $407 worth of merchandise on hand and can support 250 days worth of sales, that means our inventory will be that 407 times 250. We're told our fixed asset turnover is 1.6. That means our sales are 1.6 times as high as our fixed assets. So we can take our sales, divide it by 1.6. Our total assets then will be the 171 plus the 101 plus the 76 plus the 24. 374,276. Accounts payable, we're told our payable period is 150 days. This is basically the exact same computation we do for our inventory, since our inventory was in days. We're going to take our average daily cost of goods sold the 148 divided by 365, and once again, we get the 407. Then we simply take that 407 per day and multiply it by the 150 days. We're told that Eagle issued $10,000 in new common stock. So common stock will be last year's 40,000 plus 10,000. Retained earnings, of course, is beginning retained earnings plus net income minus dividends. Our total liabilities and equity will be our retained earnings plus our common stock plus our debt plus our accounts payable. Now, as a last step, we can put in our debt plug, because again, our balance sheet has to balance. So we're going to take our total assets, subtract off what we've financed with accounts payable, subtract off what we've financed with common stock, and what we've financed with retained earnings. And our pro forma is complete.